Good evening, everyone. My name is Yogesh, and we have Michael Hewson from UK CMC Markets, who is one of our almost 25 years of experience trading the financial markets. Primary focus, what he's doing right now is on providing technical and fundamental analysis on daily movements in financial markets, as well as has written a lot of research articles which are focused on financial and economic issues. He has delivered a lot of seminars on trading. He holds a MSTA from UK Society of Technical Analysts and also a CFTE from International Federation of Technical Analysis. Now, over here, our complete agenda is about the outlook of 2021, and he will be throwing a lot of light and will be answering a lot of your questions. Once again, extremely sorry for the delay. This is a software issue. We almost were able to shift everything to Zoom. And then this started working, so we stuck onto it and we have finally started this. So I really appreciate your time. Please write your questions and queries. And Michael, you're on. Thank you so much for taking our time and doing this.
Thank you, Yogesh. Once again, my apologies for the technical issues. At the moment, I am trying to juggle any number of different problems, notwithstanding the fact that I had a PowerPoint presentation which I wanted to share with you. Unfortunately, I haven't been able to upload it, which is a little bit disappointing from my part. Nonetheless, I'm going to try my best to try and cover the topics that I had in mind, certainly in the context of what I want to talk about. I'm going to be looking at the investment outlook with respect to 2021. I'm going to be looking at it through the context of Dow theory. I'm going to have a look at the correlation between DAX, S&P 500, Nikkei 225. Look at how those major indices tend to move in conjunction with each other. Looking at central bank and fiscal policy, how the vaccine rollout could dictate how the markets are likely to continue to rebound. Look at possible variant risk as well. If you see me looking to my side, it's because I'm looking at various questions that might be coming my way over the course of the next few minutes. Obviously, if you do have any questions, I will try and deal with them as and when I can. Going to be looking at it. Going to be looking at the markets on a cross-asset basis, so looking at equities, bonds, or both. Look at various themes. What sectors have done well? Renewables. Looking at solar, wind, driverless cars, and what have you. Look at the commodity sector. How the rise in commodity prices that we've seen over the course of the past quarter or the past 2 months since the beginning of the year has raised inflation expectations and obviously prompted the big jump that we've seen in yields over the course of the past few days, and whether or not further rises in yields could well impact the rise that we've seen since the beginning of 2020 in equity markets. You may recall we saw a very big sell-off in March last year. Well, in February, March last year, we peaked around about the 18th of February, came crashing down before bottoming out around about the beginning of April. And ever since then, we've been trading progressively higher. And I think the big question that we're all wrestling with at the moment is whether this particular move higher in equity markets has further legs in it. Looking at foreign exchange, whether or not the US dollar is likely to weaken further, what the outlook for the pound is going forward, looking at gold, Bitcoin, looking at various risks to the outlook, trade, inflation, potential banking crisis in Europe. Certainly, I think the European Central Bank is very concerned about the recent rise that we've seen in German yields, Greek yields, Italian yields, Spanish yields, and the cost of borrowing in the periphery, and concerns that the rise in borrowing costs there has prompted a significant degree of pushback from the likes of Christine Lagarde, head of the European Central Bank, the Central Bank of France Governor Villeroy, who's also pushed back on the rise in yields, and this morning Fabio Panetta, who's also a member of the Governing Council, who's also pushed back on the rise in yields, urging ECB officials to use every single euro in the PEP to try and keep a lid on peripheral bond yields. Certainly at the moment, the noise that we've been hearing from central banks has been that European central bank officials are much more worried about the rise in yields than Fed officials. I think Fed officials have been playing down the risk. We've got the presentation. So I'm going through the investment outlook for 2021 at the moment, and I'm going through the various introductions. So we've got to the risks to the outlook. We've got trade, inflation, banking risk in Europe, and obviously the Biden green agenda. Now, we heard an awful lot from the Democrats about their Build Back Better Green New Deal. And I think an awful lot of that drove the big rise that we saw in renewables over the course of the past 9 months. If you say, for example, look at our baskets, our share baskets, which are on the platform right now. If we could just flip back to that, please, Yogesh, flip back to the platform so that I can display that. That would be enormously useful. If we flip back to the platform,
Michael, you can do it from your end. I've just uploaded. Yeah, I've uploaded the presentation. You can just share the screen here.
So how do I flip back?
Just click on the screen share, and this will help you.
Right, I'm trying to find the screen share. Hang on. Right, there we go. All right, between the two. Okay, and back. Right, it's not working.
Right, just 1 second. Okay, just give me your demo. I'll open right here.
Right, well, before we try and flip over, I'm going to flip back to the PowerPoint presentation. So I apologize for the technical problems that we're having. Looking at the PowerPoint presentation, I've looked at the correlation between FTSE 100, the S&P 500, and the Nikkei 225 and the German DAX. Now, they are color-coded, so you can see which line represents which index. And we can see straight away that there's a significant outperformance since the beginning of 2020 on the part of the Nikkei 225 and the S&P 500. We can also see that the German DAX and the FTSE 100 have significantly underperformed. Now, why is that? Well, obviously, with respect to the German DAX, the pandemic has hit Europe very, very hard. It's coming from a much more fragile base, and ultimately, because Germany's export capability, a good portion of its export capability goes to the periphery, i.e., Spain and Italy, and to a certain extent France, but also China, which was also hit very hard by the pandemic. So the DAX has underperformed simply because the global economy has been struggling as a result of the pandemic, and Germany's key export markets have been struggling as a result of the pandemic. So as you can see, when we came crashing down in February, March, we pretty much started to rise in unison. And then around about July, August, we got significant divergence in terms of Nikkei 225 and the S&P 500, simply because the Fed was much more aggressive in terms of the monetary policy measures it was implementing to rescue and underpin the US economy. There was also much more fiscal stimulus from the Trump administration. The CARES Act was rolled out, which expired at the end of July. And then obviously there was the promise of more fiscal stimulus towards the end of 2020, $900 billion, which was finally passed in the twilight of 2020. And we've also got the prospect of another $1.9 trillion of fiscal stimulus currently going through the House. So you can certainly see in terms of the S&P, we've got significant amount of outperformance there. On the Nikkei 225, similarly, the Bank of Japan has been very aggressive in buying Japanese ETFs and also holding interest rates down and coming down on the yield curve there. So you've got significant outperformance on the part of the Nikkei 225. It's also important to remember the Nikkei 225 is well below its peaks of 1989. And it has finally been able to move back above that 30,000 level that I think from a psychological point of view was very, very important in the overall scheme of things when it comes to further progress higher. If you also look at the Nikkei 225 on a valuation basis relative to the S&P, it's probably quite a bit cheaper as well. So what I'm specifically looking at is what's going on with respect to the FTSE 100. That has lagged quite significantly behind the rest. And I certainly think there's significant pockets of value there. My target for the S&P, my target for the FTSE is around about 7,000 by the end of Q1 this year. Now, obviously, I think it's probably going to fall well short of that, but it doesn't change my underlying belief that because of Brexit, and now that's in the rearview mirror, and because of the fact that the UK is well ahead in terms of the vaccine rollout, that there is significant potential for the UK assets in particular, to bounce back quite strongly. And that's why I think that irrespective of the value or the rebound in the pound that we've seen, that there's more potential upside in the FTSE 100 than there is, say, for example, in the S&P. And I've still got an end of quarter target of around about 4,000 in the S&P 500. I do have concerns, I think, on the margins that we might see a little bit of froth blown off there because of some of the high valuations that you're seeing in the more highly valued parts of the market. And I think that's no better borne out if we look at, for example, this particular chart here, which I've got on the platform at the moment, and which I hope I can flip over right now. Hopefully that the technical gremlins have been sorted out, and it would appear that they haven't. So
Michael, it's working, or should I'll upload your platform in mine. Nothing to worry. Just 1 second.
I can't see it on my screen, Yogesh. So
okay. Just give me a second.
It's not, I mean, can you see the platform, guys, on what's in front of you right now? Can you tell me what you can see?
It's the presentation so far.
It's just a presentation.
Yeah, just 1 second. Let me upload your. It was demo 14595.
Right, you've logged me out. Okay. All right, well, while we wait for Yogesh to sort the platform out, let me move on to the events of the last few days, because I think there has been one of the big questions that I've been wrestling with, and I think investors have been wrestling with over the past few days, has been whether higher rates are good or bad for stock markets. Certainly the reaction function that we saw at the end of last week was that higher rates are not necessarily good, and that higher real yields could actually have a significant impact on, say, for example, equity markets, particularly when you've got an S&P 500 that is trading on a forward yield of around about 1.5%. And when we saw US 10-year treasuries go up to 1.6%, I think there was concern that the speed of the move higher, and I think it's more than anything concerns about the speed of the move higher that's really, I think, been at the forefront of why investors were a little bit nervous about the Fed's sanguine attitude to the rise that we saw in the long end of the bond market at the end of last week. Jay Powell suggested that essentially high yields were a symptom of an economy that's doing very, very well. And who am I to disagree with that? But I think more than anything, it was the speed of the move higher rather than the actual fact that the yields was significantly up from the levels that we saw at the beginning of the year. If you look at US 10-year treasuries at the beginning of this year, they're at 0.9%. They're now around about 1.4%, and they were as high as 0.6%. If you look at UK gilt yields, they're at 0.2% at the beginning of this year, and they're now at 0.7%. So essentially, you've had in essence, around about 2 or 3 rate hikes priced into the long end of the yield curve in the space of 2 months. And I think that more than anything has been what's really been spooking investors. And I think it's incumbent upon central bankers to try and address that disparity or that shift that we've seen in market expectations with respect to the long end of the yield curve. Because if you look at 2-year yields haven't really done anything apart from a brief spike towards the end of last week. Since then, they've come down, but ultimately what we're seeing at the moment is a little bit of anxiety on the part of investors as to the overall direction of long-term yields and the speed of long-term yields. So we've seen a softening of yields over the course of the past few days, and I think a part of the reason for that has been that copper prices and commodity prices in general have started to show signs of topping out. We've seen oil prices start to show signs of running out of steam. We've got OPEC plus at the end of this week. I think pressure is now being brought to bear in terms of some of the smaller nations are saying, we really do need to start upping production to take advantage of these higher prices. And I think more than anything, if commodity prices show signs of topping out, yields should take care of themselves. Now, there are some particular patterns I really want to show you guys on commodity prices that would suggest to me that maybe we have topped out in commodity prices. And if Yogesh can give me the okay to try and share my screen again.
Yes, Michael, I'm trying. You can see a presentation, right? I have shared the screen already with you.
Okay.
I think it's a whole server issue what we are facing today. It's just
okay. So basically, are you able to log on your screen and then I can basically work off your screen with the login that I'm using? Because if you can do that, then hopefully I can work remotely and work on that basis. Because if I can see your screen with the presentation, I can surely see your screen if you've got the platform logged in.
I have logged into the platform now. It's already on.
Okay, perfect. I'm going to talk about this slide first and foremost, though, which is the US 10-year yield. What I've done here, ladies and gentlemen, and I really must apologize for the technical problems. I am trying my best here. We peaked out for the US 10-year treasuries just above 3.2% all the way back in 2018. Now, we bottomed out around about the middle of last year, around about 0.4%. Since then, we've come back around about 38.2%. So we're currently trading around about 1.4, and the 38.2 is about 155. We overshot slightly to 166. So I think for me, the danger zone, the US Treasuries, and I'm looking at the chart in front of me right now, even though I'm slightly looking off camera, is 38.2%. So from a technical standpoint, I'm not overly concerned about this sharp move higher in US 10-year treasuries unless or until we move above 155. And even if we do, we're only going to be going back to the levels that we were at just over a year ago at around about 185, 187. So that might be around about 20 or 30 basis points above forward earnings for the S&P 500. But certainly in terms of real yields are still negative on US 10 years when relative to core CPI, US core CPI. They're negative to the tune of around about 0.1%. More importantly, US five-year inflation expectations have started to come off the highs that we saw at the end of February. So I think more than anything, concerns about forward inflation expectations have softened ever so slightly. So I was talking about US 10-year treasuries and the fact that the 155 level is a very key point for me. And I was talking about the reason why we've come back down. And a large part of that was because of a topping out in copper prices. So I'm going to look at the copper cash price here. Now, Yogesh said earlier that I had significant interest in technical analysis, and candlestick charts is something that I look at a lot. So if I maximize this chart so that you, ladies and gentlemen, can see it, you can see that if I zoom all the way out here, we've come an awful long way from the 200-day moving average, an awful long way. And at some point, this divergence needs to correct. Now, if we look at this here, this is what we call in the trade as a key reversal day. What we've also seen in UK stocks, and particularly mining stocks, Anglo-American being a case in point, is a similar daily reversal on UK mining stocks. Unfortunately, on this particular platform, I don't have live access to be able to show you that, which is unfortunate. But ultimately, what I look for is correlations to confirm an overall view. And what this copper price is telling me on the dailies is this key reversal day suggests that we could well have seen a short-term top. Now, obviously, that on its even by itself, it's not a green flag to say that we're going to come back lower. But what I would suggest is that ultimately, while a topping in commodity prices, given the correlation that we've seen in equity prices, could be construed as slightly bearish because they've moved in lockstep with each other, I think we can all agree that the current move higher in yields has been unhealthy when it comes to yields. So any softening of inflationary pressures is likely to take the upward pressure off yields and potentially increase the attractiveness in stock markets more generally and pose less of a risk to risk appetite going forward. So if I look at this and then I drill down into 4 hours, I can then look at the potential resistance levels for what it could potentially be a topping pattern here. Now, if we look at these highs here, around about 420 on copper, this reaction move higher, I think, really needs to stay below this series of peaks through here to suggest that we're going to see a sideways consolidation in copper prices from these sorts of levels. The PMIs in China, the recent PMIs in China that we saw earlier this week, suggest a slight softening of economic activity, which again could feed into a narrative of a sideways consolidation in copper prices and potentially a softening of the inflationary outlook going forward. So this is telling me, this is showing me a little bit of a red flag when it comes to further strong gains in equity markets going forward. More importantly, the Aussie dollar, which is also a significant bellwether for commodity prices, is also showing a little bit of softness as well. And more importantly, if we go all the way out here, we can see that if we go back further enough, there's a series of tops all the way through here from 2017, 2018, which could also limit the upside in Aussie dollar as well. And again, we've posted a bearish key day reversal in the Aussie dollar. Now, if we take that back through here, we can see that around about 78.20, 78.30, there could be a significant amount of selling interest through there as well. So in terms of the overall upward pressure in Aussie dollar, we could see a little bit of softening there if we don't get back above 78.30 on the Australian dollar. So for the outlook for me in terms of the Aussie, I'm slightly cautious about further gains in commodity prices going forward, particularly if we also look at Brent crude prices as well. Now, obviously, that's slightly less cut and dried here because we haven't got the same sort of candlestick formation. But what we've certainly got is some evidence that we could well see a little bit of softening of crude prices as we head into that OPEC meeting later this week. So really, it depends on where we finish this week when it comes to commodity prices more generally. So At the moment, what we're looking at is, for me personally, I think commodity prices, we could see some of the froth start to come off. That could take some of the upward pressure off upward inflation expectations and could take the pressure off equity markets more broadly, particularly if we look at some of the more undervalued sectors of the market. So has anyone got any questions thus far on what we've covered more broadly? Also, one of the reasons gold prices have started to look a little bit weak is this technical breakout that we saw on this daily chart here. This suggests to me that gold prices have probably got further downside towards 1686. That would suggest to me that risk appetite is likely to improve going forward because of this technical break that we've got here. Now, if we measure this move down through here, we have the potential for gold prices to come all the way back to this series of lows down here in April 2020, around 1660. Generally, gold coming off is a good thing for stock markets more broadly. There tends to be a little bit of an inverse correlation. Obviously, the dollar has strengthened ever so slightly, and I'm probably more bullish on the dollar than probably most people are. People have been writing off the dollar for years, but when I look at the dollar, I see a currency that's potentially starting to show signs of bottoming out. And if we get a significant rebound in the US economy and the Eurozone economy struggles, then why would you want to own euros? Because essentially the European Central Bank is going to double down. And I think this is really about when the vaccine rollout starts to gain traction in the US and the UK, the Eurozone is lagging behind. Who's going to come out of it more strongly? I think Europe is going to struggle. We've already seen the EU's response to the vaccine rollout program. It's been fraught with problems. Angela Merkel, Chancellor of Germany, has already said that she wants to extend lockdown to the end of the month, March. The likelihood is that even if certain parts of the Eurozone economy do improve, the holiday season for Spain and Italy and Greece is going to be very difficult this year. You've got all this talk about vaccine passports. Who's going to want to travel to Spain or Italy if you're going to have to quarantine on your return? It's going to be very, very difficult for Spain, Italy, and Greece to open up unless the vaccine rollout is as far advanced as it should be, and people will then feel incentivized to travel. So certainly travel and leisure is going to not see a significant pickup, I don't think, until the beginning of next year. We've seen a big rebound in travel and leisure stocks, and I think to a certain extent that's justified. But anyone who thinks that we're going to see normal service resumed in 2021 to the levels that we saw in 2019 is, I think, in for a little bit of a shock. I think it's wishful thinking. I think we'll see certainly a much better Q3 than Q2 or Q1, but will air travel return to the levels that we saw pre-pandemic? I think it's highly unlikely, much before 2024. So that means that airlines are going to be much smaller over the course of the next 3 or 4 years, and that is going to present clear problems for the tourism industries for countries like Spain and Italy. Only this morning, we saw that 13,000 businesses in Spain were closed. Unemployment is 4 million in Spain. That's 16.4% or above, and likely to get worse in the absence of any significant uplift or any fiscal response. And the pandemic recovery program that the European Union have put together, 750 billion euros, 350 billion euros of grants, it's too small. It's too small when you set it against the $1.9 trillion of US fiscal stimulus on top of the $900 billion of fiscal stimulus we saw at the end of last year, and the fact that we've got a UK budget tomorrow, which could well see Chancellor of the Exchequer here in the UK extend various emergency measures out to the end of Q2 and potentially the end of Q3. So the UK economy, the US economy are getting much more fiscal support than in the European Union. The European Union still remains an area that I'm very concerned about. And I think while we have seen a significant rebound in some of the assets in that area, I'm very, very reluctant to go back in big there when the problems in Spain and Italy haven't been sufficiently addressed. And the fact of the matter is, they will need an awful lot more than the current fiscal response that they've managed to cobble together almost a year ago now. It was June last year they put together this pandemic recovery fund, and they haven't even started rolling it out yet. Contrast that with what's happening in the US and the UK, and I think it's going to be very, very difficult. And that's why the ECB is so worried about the spike in yields that we've seen over the course of the past week or so, infecting Germany, Spain, Italy, Greece, and the bond yields there. So gold prices, I think, a potential to go a little bit lower over the course of the next few sessions. And on that basis, I think stocks should continue to hold up fairly well, certainly in the context of where we are at the moment. So if I just quickly switch, I'm trying to quickly switch, and I don't think I can. So if we go, oops, sorry, I didn't mean to do that. And we're back. No, I'm going to go back to that. I'm going to go back to that. I was going to go back to my PowerPoint presentation, but it's not there anymore. So we'll stick with this. So going back to what I was saying earlier, what's my outlook for the German DAX more broadly and the European markets more broadly? Well, we can certainly see it in the context of this chart here. I'm still of the opinion we're very much a case of buy the dip when it comes to European equities. I'm just looking to see if there are any questions, and at the moment we don't appear to have any. But certainly in the context of this overall chart here, very much buy the dips on the DAX. We can draw a line through these lows through here. If I can actually find, there we go, just found it there. Draw a line in through there, then go back again. Bear with me a second. So there we go. So I was wondering if you could actually, no, okay. I wanted to go back to the presentation. I wanted to go back to the presentation, but I can't.
Just 1 second. Let me try 1 second. Can you see?
Okay. Yeah, I can see it. Okay. So can you guys see the presentation now? You could just confirm that you can. That would be good. So it's going to move on to here. One second. Okay, gold, share baskets. Okay, I'm just making a quick note of what my slides were, Yogesh, and then you can flick back to the platform. So I was going to talk about sterling and the dollar, and then quickly move on. I've covered gold already. Okay, and then going to move on to share baskets. That was it. Okay.
Michael, we also have a few questions coming up. A few outlook on silver as well.
Okay.
Yeah, just in case, like whenever, if you finish the session you want to answer, or whenever you find the time. So I'm just reading out the questions as well.
Yeah, no, that's perfect. So I'm just going to pop back into the screen now. Go back to. If I could go back to the platform now, that would be good.
Yeah, Michael, you can do it from your end, like you did last time. Just
that's not happening.
Okay.
It's basically giving me the same problem again.
Okay, just 1 second.
Bear with me, ladies and gents. These technical problems are still, the gremlins are still giving us problems.
Just
got it.
Okay, it's here.
Got it.
Okay.
Okay. So that's perfect. Silver, slightly different animal. Very much a case of buy the dip on that. We can see that quite clearly here. One of the neat features I like about the platform is the ability to snap to highs and lows on trend lines. That's right there. So we can see we're right on trend line support here on this particular chart, on the daily chart. And if I want, I can then extend the line to the left to take in the lows there. So very much in an uptrend on silver. Think that as long as we hold above $24 an ounce and the 50-day moving average, then for me, the line of least resistance for silver is a move back towards $30. I mean, that $30 is a big level. We can't escape that fact. And even though the Reddit crew tried to take us through $30, they were always destined to fail. But certainly in the context of how far we've dipped back, while we stay above this series of lows through here in the 50-day moving average, you've still got to be fairly bullish on silver and metals more broadly, simply on the basis of the renewables trade. And why do I say that? Because ultimately, one of the things that President Biden has said that he is very passionate about is the transition from fossil fuels to renewables. And one of the reasons why copper's done so well is because copper is used in pretty much every single renewable technology you can think of. It's used in the construction of solar panels. It's used in the construction of battery technology. It's used pretty much in every single electrical device you can think of. So if you want to go through, if you want to basically pursue the renewables route, then you've got to dig a whole lot more holes in the ground and mine an awful lot more copper. That's not very climate friendly, is it? But unfortunately, it's either that or fossil fuels. So it's really, the lesser of two evils. And that's why I think companies like Anglo American, Rio Tinto, and BHP will probably continue to do well, simply on the basis of the fact that the demand for base metals, nickel and tin, have also done pretty well, as have platinum and palladium. If you extrapolate future demand for renewable energy basically not only uses base metals, obviously it uses rare earths as well. And obviously I think that's where China will also come in. So, all in all, I'm fairly bullish on dips for silver and anything that's used in renewables. Now, we were talking about baskets earlier. And one of the things I like about share baskets is not only do they allow you to diversify your risk quite significantly, but they're also fairly decent proxies of which sectors are outperforming and which sectors are underperforming. Now, in this particular share basket that I've got in front of me here, the black line is big tech, the S&P 500 is the red line, and collaborative technology is the purple line. Now, it's not hard to see what's been driving the S&P 500 quite a bit higher. It's basically been all the new technology stocks. So your Zooms, your DocuSigns, your Slack technologies, which obviously got bought out by Salesforce, your Ubers, your Lyfts. Ultimately, whether or not a company is profitable is neither here nor there. All of the companies, I was listening to Bloomberg this morning, and apparently all the companies that are actually not making any money are up 25% this year already, which suggests to me that ultimately investors don't really care whether or not the company makes money. It's about whether or not they think it can make money going forward. Look what happens though when I add renewables to this comparison chart. So I just drop and drag, change that to blue, and look at renewables. I mean, that's renewables, and look how well that's performed since July. It's actually gone on a massive growth spurt, and the reason for that is companies like First Solar and Enphase Energy, which you can all find on the platform fairly easily in the product search list. And these have outperformed significantly over the course of the past few months, with the potential that they could continue to do so. So they've blown big tech, companies like Zoom Technology, Peloton and the like, into the weeds. And part of the reason is once President Trump's polling numbers started to go south towards the end of July, and it became apparent that Joe Biden was probably going to be the next president of the United States, money started to go into renewables at a rate of knots. Now, we've seen a little bit of a pause since the inauguration. We've seen a marginal new high, and we've come and dropped back a little bit to be around about 200% higher. So really now, the big question is, and the Biden Green administration is, how much of that $1.9 trillion of fiscal stimulus will go towards renewables? Will the Biden administration be able to get a significant green agenda through the Senate? And bear in mind that there's a 50-50 split with Kamala Harris, Vice President, having the casting vote. How much of that $1.9 trillion will find its way into solar energy, renewables, infrastructure spend to ensure that the US power grid, far from being reliant on natural gas, crude oil and what have you, and we've already seen in the case of Texas how much the US power grid needs upgrading, how much of that money finds its way into the power grid over the course of the next 4 years. Bearing in mind we've got the midterms coming up in 2 years' time, and we've got ex-President Trump making an awful lot of noise about a comeback in 2 years' time. So looking at this on the renewables, there's certainly potential for further gains. The big question is, has all the easy money already been made, or is there further upside to be made? So that's basically an area that I've got my eye on. Has the easy money already been made, or could we see a pullback first before we go higher? My hunch is that between now and over the course of the next 2 years, there's potentially quite a bit more upside in that particular trade, which means that you can either go and look at renewables in terms of individual stocks. So we can look at something like First Solar. Here we go. This chart here, which is finding support above its 200-day moving average. So again, the 200-day moving average is an area which is a very key benchmark for me when it comes to the overall trend. I'm just making that font bigger so you guys can see it. Yogesh, if there are any other questions, please let me know, because obviously I'm looking at the screen and not at what people are asking me, so I might miss something.
Sure.
But certainly in the overall context of this chart here, what we can see here is a very key, very decent trend in place. And draw a line through the trends here, and look at this. Here we go. Do that there. I'm using the 200-day and the 50-day. Use them in conjunction with each other and complement each other. You may have seen that I've actually missed out those lines there. So if I remove that and redraw it, Draw it through that line there and that line there. We've seen a little flirtation with that line there, but what's more important is that we haven't broken below the 200-day moving average. And more importantly, if we take this horizontal line through here, we haven't taken out those lows there. So even though we've broken this line ever so slightly, because we haven't taken out the lows through here, we can extend that backwards through there. Just by the extrapolation of simple support and resistance lines, we can identify key turning points within the markets to try and identify when an upward trend might start to roll over and we'll start to turn lower again. But at the moment, on a risk reward basis, and if you're looking in terms of overall trends, if you were long here, your stop loss would be below the 200-day moving average with your potential upside back above here. What you're doing is whenever you're putting a trade or a long-term trade on is you're looking for key areas to buy, to look to get in, minimize your downside. And certainly in terms of minimizing your downside, this 77.80 area here is a very key support level along with the 200-day moving average. And to find out the value of the 200-day moving average, we just select this little button here on the left, just next to the little square. That gives you a value box, which you can then turn on, point your cursor near to the 200-day moving average, and you can see the value of the 200-day moving average, which is 76.28. So looking at 76.28 and 77.80, you've got decent area of support through here for First Solar, which means that you've got a clearly defined area where you say, right, if it goes through here, I'm out and I'll have a look at it some other time. If you're long at anywhere near these sorts of levels.
So also, Michael, the thing which we are doing with the charts, I think it kind of represents good entry and exit points as well. Some of the clients have a similar interest. I think we have all seen the rise of cryptocurrency in this last few months. So what's the future of Bitcoin and other alternative currencies? I think I have a question here which has been asked.
Yeah, I mean, Bitcoin is something that unless you have got very deep pockets, and I mean very deep pockets because of the swings. I mean, look at the swings that we've seen in this particular market here. The 20,000 level was a big level for Bitcoin. Why? Simply because it was highs here, but it was also the peak all the way back here in 2017. So once we broke through 20,000, it was always going to go higher. And really now it's just a question of how much higher can it go. So extrapolating it all the way out here, from a technical point of view, I'm a little bit cautious of Bitcoin on a weekly chart. If we look at that weekly chart there, that screams toppy to me. We need to get back above 50,000 and stay above 50,000 on a weekly basis, because you can't take a view on Bitcoin on a daily basis. It's just not feasible because of the price swings that we're seeing. Overall, I think it goes higher, but at the moment, I think it's a little bit frothy. And the risk for me is that we drop back down to around about 40,000 before we go higher again. This bearish candle here, it's a key reversal. So on a purely technical basis, and I know it's really difficult to trade technicals on a market that moves the way that Bitcoin does. But on a purely technical basis, I would not be looking to buy this. For me personally, it's just way too risky. It's way too expensive. I'd be looking to get back in on a dip, either back towards $35,000 or $30,000 an ounce for a move back towards 60. It's for me, it's just too much of a punt. I mean, I have to profess that I do own a fractional Bitcoin, and it's not something that I'm looking to sell right now. It's very much one of those trades that I've took out 3 years ago, and I've stuffed in a drawer and I've forgotten about. I've got no interest in getting out of it or buying some more. It's just a trade that's sitting there.
So
And
basically, Michael, it's like it resembles to a lottery ticket that if you really have deep pockets, you enter. Otherwise, there's a
yeah,
lot of chaos and a lot
very
of
much,
risk.
very much so.
Okay. And what
Because
about
it's become more mainstream. It's become more mainstream, and it's certainly the more. If you're going to go into a crypto asset, then it's the one to go into, because you've got Wall Street, you've got Wall Street you've got Wall Street banks setting up funds for Bitcoin. So from that point of view, it's got much more liquidity, because you've got ETFs in Bitcoin, you've got funds being set up in Bitcoin. So it's gaining much more mainstream acceptance, but you've still got central banks pushing back on it. And there is a regulatory risk involved in owning it, in that we've already seen here in the United Kingdom that regulators have said that you cannot offer Bitcoin to anyone other than professional investors.
All right.
So
Yeah.
regulation is a risk.
So, Michael, there is one more follow-up question on that.
Mm.
With Bitcoin, the value we see is around $48,740. Even if a retail investor wants to be a part of it, the value is pretty high.
Yeah.
If we take a calculated exposure, or if investors take a calculated exposures on the alt currencies like Ethereum or Litecoin or Cardano, Stellar, others, whose value is considered like relatively less than Bitcoin.
Well, you could take an exposure in a crypto index.
Mhm.
We have a crypto index which you can use, and the quickest way to look at that is you go to the crypto section there, and I'm hoping that it's in here somewhere. I don't think it is. Hang on, give me a second, see if I can find it. It could be somewhere else. Let me just see if there is a crypto, if the crypto index has been enabled. Oh. So
It's not enabled yet, Michael.
it's not enabled. Okay.
It's not enabled yet, yeah.
But there is a crypto index which enables you to spread your risk across the crypto, across all the cryptocurrencies. Obviously, the heaviest weighting is towards Bitcoin,
Okay.
but certainly in terms of spreading your risk across all the cryptos, that would
Yeah.
probably be one way to diversify, so that you're not just exposed to one particular coin.
Okay.
Whether it be Cardano, Dash, Bitcoin Cash, or Ethereum, for example.
Okay. Michael, there's one more question on the Bitcoin chart itself, given the technical
Sure.
perspective.
Let me just bring that back.
Yes. Somebody has seen, I see a trend reversal price pattern with yesterday's green candle, and also there's 50% Fibonacci retracement for the up move from 29,000 to 58,000. Okay, I think it's a more of a
Well, from here to here, yeah.
Yeah.
Let me just pull that up.
Yes.
Fibonacci retracements. So it's from here to here.
Correct. I think that's the one.
Is that the one? Let me just get rid of one of the good things about this is you can get rid of the lines you don't need. So
Right.
essentially just click on that, go to the settings, go to the values, and I've knocked out the 23.6. So it's not something that I particularly use a lot.
Mhm.
I'll keep it if it coincides with previous highs and lows, is particularly important. In this case, it's not. But certainly the 50% level is around 43,218. So we've managed to hold above that, absolutely. But the thing that worries me the most about all of this particular move in Bitcoin is when you actually extrapolate that out onto the weekly chart, you still can't escape the fact that you've posted a bearish weekly reversal on the weekly chart.
Mhm.
And given the extent of the move that we've seen, I'm reluctant to be aggressively long at these sorts of areas, simply
Okay.
because of the risk that this candle here poses. So if we take that out, what I would suggest, if you're concerned about being long, then this low here on this daily candle from let me just pull that up. So this low here from last Friday, around about 44,000. If we break below 44,000, we could tumble back towards around about 39,800. So if you're looking to buy Bitcoin, then the 61.8 Fibonacci retracement level is as good a place as any, simply because 40,000 is probably going to be a bit of a round number. You're going to get some buying interest around
So
there in
40,000 is
anticipation of a bounce. So
40.
39,800, 40,000.
Okay, that's
If you're using 28,000 or 30,000 as an area for a Fibonacci retracement on the move from those peaks there.
right.
I mean, you could also argue that this particular candle here is a hanging man on a daily chart, hanging man chart on the daily candle. So, which all then extrapolates out to, the weekly close that we saw on the candle there. So, as I say, it reinforces my point. I'm a little bit twitchy about buying Bitcoin. I could be wrong, but I've been in this game for 25, 30 years now. And if my gut feeling is telling me not to do something, then I've learned to trust it. It's not always right, but it's kept a roof over my head.
Right, Michael. So that's good. We have one significant question. It's more of a very general question which is coming in. I think it's very connected to what has happened in last 1 month with the Reddit community. The question is, what happened with GameStop and AMC and the stocks regarding the Reddit community? Are investors really so naive in the market that they would go for things like this and start buying a stock which doesn't have a very strong fundamental?
Yeah, I think the thing with the GameStop thing was that you've heard all the chatter about if the market's all one way, how much lower can it go?
Yeah.
And if you look at GameStop's open interest, 200% of the shares were out on loan. So GameStop was always susceptible to a short squeeze because it was so leveraged to the short side that any move higher would have potentially triggered an awful lot of people covering their positions. And that was the problem. The Reddit crew identified a stock that was so overly leveraged short that they thought there's a trading opportunity here. And don't buy into the narrative that the Reddit investor crew are naive. There was an awful lot of people on that Reddit forum who were probably IFAs and probably well clued up and trading on their own personal accounts. And they leveraged an opportunity and they took advantage of it. And I think if we can take away one lesson from the GameStop saga is that if you put all your eggs in one basket, as certain hedge funds were doing, then you are going to get burnt. And AMC Entertainment was a typical example of that. In fact, I'm going to show you that chart right now because AMC Entertainment, who own the IMAX cinemas and Odeon cinemas, also had an awful lot of short interest. And as a result of certain hedge funds basically paring back their short positions, we can see on this chart here, I mean, that chart is absolutely is incredible. And suggested that ultimately an awful lot of people were over leveraged to the short side. Now, with the best will in the world, you're not seriously telling me that the cinema model at the moment is a money-making model. And yet AMC share price went all the way back to before the pandemic, when the cinema sector was under severe pressure from streaming Netflix, Amazon Prime, Rakuten, Roku, Apple, Disney. One thing AMC did get right was they managed to sell an awful lot more shares at these sorts of levels, but it doesn't change the fact that the cinema model is under severe pressure. If anything, what it's made people do is be very careful about areas that they look to aggressively take short positions in, because I think having short positions is a good thing to have, but you have to be very careful about being overly aggressively short, because you could get burnt, as
Right.
you can see from this chart here. And we can see that ultimately the business model is no less broken, even though we've trebled in price from where we were in 2021. If you look at Cineworld over here, it's a similar sort of story. When are people going to go back to cinemas? So if there's a lesson to be taken from the Reddit crew and the GameStop thing, is that be careful jumping in onto a trade that people tell you can only go down. Look at the short interest in it first. And if it's telling you it's a crowded trade, probably is.
That's great, Michael. Michael, before we leave there, I think one or two more questions which I'm seeing, and one of them is interestingly about the ESG investment. Since you have talked about renewable energy a lot, it's a question here. Are ESG investments, are they able to achieve the alpha if you're investing in? Like, is it something rather we invest into S&P 500? Because there has been always a concept that if you're investing into environmental companies or social companies, that's good. It's kind of a good impact investing, but it doesn't do justice with the alpha or with achieving the returns on your portfolio. Is it something which still goes on?
ESG is one of those very big catchphrases that's very, very popular with TV anchors on Bloomberg. I think if you're looking at the environmental credentials or ESG credentials of any given company, I think it pays to do your research. And we've talked an awful lot about the environment and what's likely to be the key areas, or you're talking about essentially thematic investing. So looking to invest away from areas that are polluting and towards areas that are likely to grow significantly over the course of the next few years. I think in terms of innovation and looking forward, sovereign wealth funds generally have a good handle on where the next growth areas are. I don't think it's any coincidence that companies like Royal Dutch Shell and Statoil and BP, the Norwegian sovereign wealth fund has been steering well away from them and steering much more towards companies with greener credentials. Unfortunately, people use ESG to say, well, we're ESG friendly, when they may well not be. And, while I think my answer appears to be a little bit woolly, I think you have to do your own research in this regard. Maybe look at an ETF. I've heard an awful lot about in recent times, and also SPACs. You hear a lot about SPACs, ETFs, ESG, and what have you. They're all very nice catch-all phrases, but what do they actually mean? And for me, when I hear ESG, what does it actually mean for me? And we're a company and we're ESG. Well, what does that mean?
So,
and I think,
yeah.
So go on. Yeah, what were you saying, Yogesh?
No, sorry. So please go ahead. Yeah.
No, because you were going to jump in and I cut you off.
No. What I was simply suggesting, yes. I mean, what you correctly suggested, that there are a lot of ways to take exposure. Just to summarize it, that there are a lot of ETFs. I think we have been listening about ARC ETFs as well, which is related to.
Yeah, I mean, we've looked at Cathie Wood, right? Cathie Wood is the ARC Innovation ETF, and yes. I've got this chart ready for you. And there's been an awful lot of toing and froing about ETFs and ARC Innovation ETFs, and the fact that she had a very large position in Tesla,
yes,
for example, and she's cut that position down. She had to cut that position down, and people are now starting to write off the ARC Innovation ETF because It's very heavily geared towards Tesla and the fact that Tesla doesn't make any money, and that Elon Musk is invested in Bitcoin. And the only reason that Tesla makes money is because it's selling credits, carbon credits, and it's selling, and obviously he's longer Bitcoin. It would be nice if he actually started to make money from selling cars. And then you've got the SPAC ETF. Sorry, you've got SPAC Churchill Capital, who's just bought Lucid Motors or invested in Lucid Motors, who's a big player in electric cars. And that SPAC has been trading in a very volatile fashion. Just look at what the price action is doing from a technical standpoint. That tells me all I need to know in terms of the ebb and flow of capital flowing in and out. Show me the money, I think, is one of the biggest things that I've always looked at when it comes to price action. What's the money doing? And in this ARK Innovation ETF, since March last year, we've seen some really solid gains over the course of the past 12 months. The trend is very much higher and is continuing to be higher. So until such times as we break this trend line here and this series of lows through here, so I'm going to draw that line in for you, then the ARK Innovation ETF is still very much a case of buy the dip.
Right.
The trend is your friend until it comes to an end.
Correct. Yes.
Yeah. And at the moment, the trend for the ARK Innovation ETF is higher until such times as we break below this low here and this trend line here. Sometimes it's very, I've got a rule of thumb. If it sounds too complicated, it generally is. So I'll strip it back to what the price action is telling me. And what the price action is telling me here is that this trend is up, and I'm going to be a buyer of the dip of this until such times as the trend tells me otherwise.
Correct. Okay, that's great. So, Michael, just to wrap up, last question. I think it's one of the most interesting questions that seems throughout. And this is, again, very general, but then I'm sure we'll try to find this answer out. So somebody wants to know that being retail investors or regular investors, how to get gains while such kind of manipulations are happening where big institutions, like the biggest example you gave about Tesla, the stock still goes up, then a tweet comes out, Bitcoin goes up, then GameStop happens, AMC happens. So while these manipulations are happening left and right, what is a way for a small investor? How do a retail investor makes money in this?
They have to do either, well, retail investor, you're talking retail investor or retail trader, because there's two distinct distinctions here.
Consider an investor who is less aware about what happens in the market, is mostly looking forward for investment sort of thing where you can get steady returns.
Yeah,
not daily trades. Yeah.
The one thing I would say is that you wait. For me, I wait for the market to come to me. So ignore the noise and trade the levels. And I know it's very easy for me to say ignore the noise, because that's what it is. Elon Musk says this, so and so says that. It's noise. It's noise. It's market noise. You've no idea how much market noise I get to hear during a trading day. I'm on Twitter all day. I see all manner of stuff coming down through my timeline. I hear central bankers saying this. I hear other central bankers saying that. You've got CEOs who are only keen to really talk their market, talk their stock up. The big thing that I would say is that look at what the price action is doing. Identify the levels where you might have an interest to buy. Go in at those levels, stick your stop loss at a fairly decent distance away, and then trade according to those levels.
Stop loss is important.
Stop loss is important. Risk management more than anything.
Yes.
Wait for the market to come to you. So I used a silver example. I used an example in silver earlier with respect to this chart here. Now, let's say, for example, I'm looking to buy into the silver market. If I'm not comfortable buying at this trend line here, for example, I would look to buy on a dip back to $24 or just above $24,
Right.
because it's above a support level. It's above a 200-day moving average. So it's above a key support area. It's above an area where I feel comfortable buying it, but where I can put a stop loss far enough away that if it does break, it doesn't cost me an awful lot of money.
Correct.
And therefore I'll take a minimal loss. So the trick is to minimize your risk, getting in at a level you're comfortable with and where your risk level is comfortable as well. And that you know that if that breaks that level, then it's likely to fall quite a bit further and you get out as a smaller loss as possible. But if it rebounds, your upside is significantly sufficient that you can make a decent amount of money relative to the risk that you're taking on, if that makes sense.
Right. So, Michael, just to reiterate, do you really think that a market plunge is coming in, given the bond yields going higher now, and we have seen a drop down in a drop in equities? Is there a possible? It's a very common question which people have. The past rally which we have seen in the last 1 year after the pandemic, markets all-time highs, with vaccines rolling out now, do we get to see another crash coming in, or it's going to be a buy on dip situation with the equities?
I still think equities are buy. I still think equities are buy on dips. Why? Simply because I haven't seen any evidence so far that the upward momentum that we've seen is showing signs of slowing down. Let's look at the S&P 500 as an example. So quite simply, what are the highs doing and what are the lows doing? So if we take this low here and this low here and that low there, each low is higher than the previous low. So in essence, what that means is the buyers are waiting. They're not waiting anywhere near as long to get back in on any single dip.
Buy on dips, yeah. Okay.
Buy on dips. So if this low here, you see this low here?
Right.
If this low here gets taken out, then obviously I'd be concerned, because what's happened is that these progressively lower highs, we've broken the sequence of this sequence of higher lows. We've broken that sequence, and that would be a concern. So if we break below this low here of 37.87, then that could be the first indication that we're running out of steam on the upside. Conversely, don't just look at the S&P. Don't just look at the S&P. Also look at the Nikkei 225, because we're talking global markets here, and global markets don't go up and down in isolation. So what we've got here, again, Nikkei 225, higher highs, higher lows.
Yes.
So no indication whatsoever that the upward trend in equity markets is coming to an end. Similarly, German DAX. Let me just maximize that for you. Probably not as obvious, but again, higher lows, not quite higher highs. We're range trading at the moment. But what's important is that when we dipped, we didn't take out that low there.
Right.
Okay. FTSE 100, slightly more problematic, but nonetheless, I still think that while we're above this key support here, then we should break higher here. And if we do break up higher through here, then if we measure this move from 63.40 to 68, we should take out this high here and head towards 7,000. So I'm still constructive on equities unless US Treasury yields, 10-year Treasury, go through 2%.
Right.
And so we're not there yet.
So basically, the idea is that from a technical perspective, it is good to keep your moving averages intact. It kind of gives you a basic idea of to what extent the market can fall and you can enter into, and if it falls Please, if you will have more questions,
Yeah.
do write to us or talk
all
to
of
your
this,
managers,
yeah,
and
this
I
is
will try
big
to
picture.
directly get your
What
queries.
is the big picture?
Till then,
it's
please
very,
stay
very
safe.
easy to get
A big
sucked
vote of
into the
thanks
intraday
from
moves, the
Century
volatility
Financial,
up and
the
down.
team, and myself,
But what's
to
important
all those
is
people
what are
who
the key
are
levels?
working in
Where are the
medical
key
or
levels on
healthcare
the
sector,
S&P, the Nasdaq,
or who
the
have
DAX, the
friends or
Nikkei,
relatives who are working in
the
healthcare
FTSE
industry.
100?
Pandemic is
And
not
all of the
over
key
yet,
support
and
levels
everyone
are
who's working into
intact.
this
And while
sector
they're
is
intact,
risking their
for
lives day in,
me,
day out.
it's
And I
still very
really, really
much
appreciate on
buy the
behalf of
dip.
my family and my
Cool.
entire team in Century Financial. Thank you
Really
so much, very, very much for your questions.
You're
and
welcome.
I hope everybody stays in
You're
good
welcome.
questions come. And definitely in good well. Make sure that we'll be safe this down and be invested.
I just like to
let's
address
have
one
more
question.
training session again.
When buying the dip
my name is
turns out to be
Sukesh.
catching
Thank
up
you
a
so much.
falling
Do
knife, how
review
to
us on Google,
differentiate that?
and
When
we'll
it
meet
breaks
soon.
through the support levels you've identified. So if we break below here, then we have to reassess our strategy. But while we remain above the key support levels, you're not catching a falling knife, you're buying the dip. When we break through the support levels, then you're catching a falling knife. Because ultimately, what you're then doing is you're having to try and identify where the next key support level is. Now, you could be right about that, but you could equally be wrong about that.
Correct.
But does that make sense?
It does. I think it's all in the technicals when the market is volatile, right? I think this is something which proves that now more than ever, the importance of understanding the right entry and exits is really important, because there are a lot of fluctuations happening throughout the day. And keeping moving averages intact, keeping support and resistance, following the trends can actually help you understand to time out the right entry and right exits. So I think that's
the key. That's the key. I think that's the key thing, and that's
really
something
well.
that you only get through experience. So I didn't suddenly turn up in 1989 when I first started looking at technical analysis and think, "Oh, this is easy." Yeah, it requires an awful lot of work, and you will make mistakes.
Definitely.
I still make them now, but ultimately, it's the important thing is you learn from them.
Right. So that's great, Michael. Thank you so much for answering these questions. And I think we can conclude now. We have gone through the outlook for the different asset classes. We understood about ETFs. We understood about Bitcoin in the future, how the altcoins are working. We also tried to we threw some information about the crypto index, which could be an excellent addition and the very easier way to less riskier way to take exposure in the crypto market. We talked about views on gold and silver. Thank you so much, Michael. And
you're welcome. As I say, I mean, I'm glad we got there in the end, and we've overrun slightly, but I think that's the least we could have done given the problems that we had.
A lot of technical issues today, and I really would like to apologize to everyone who has been waiting 10-15 minutes extra. We tried our best to bring the experience from CMC Markets UK, Mr. Michael Hewson, who is the chief market analyst in CMC Markets and has a tons of experience. And we'll keep doing these sessions, and obviously all these sessions will be right on time, barring the technical errors. And I really appreciate your patience. So I hope,
thank you, guys.
Michael, thank you so much. Be healthy, have a safe health. Please take care of yourselves. Work from home if you need to, and always wear masks. Mine is right here in my pocket. I'm sitting in enclosed.
This is my work office right here. So, but I've been here for the last 2 months.
Great, Michael. All right, everyone. Thank you so much. Be safe. We'll be back soon with more and more webinars for all of you, and more trainings. Reach out to our consultants and always keep stop losses. I think that's the last message which we should always
give.
Thank you once again. Michael,
thank you.
Log of,
cheers. Yeah. Thank you.